let's take a few minutes to focus on underwriting standards and consumer protection principles. Underwriting standards play a huge role in consumer protection for those who may only qualify for a non-traditional mortgage product. Most agree that prudently underwritten real estate loans should reflect all relevant credit factors, including the capacity of the borrower to adequately service the debt. Prudent qualifying standards recognize the potential effect of payment shock in evaluating a borrower's ability to service debt. An institution's analysis of a borrower's repayment capacity should include an evaluation of the borrower's ability to repay the debt by its final maturity at the fully indexed rate, assuming a fully amortizing repayment schedule. One widely accepted approach in the mortgage industry is to quantify a borrower's repayment capacity by a debt-to-income ratio. An institution's debt-to-income analysis should include, among other things, an assessment of a borrower's total monthly housing-related payments, including principal, interest, taxes, and insurance, or what is commonly known as PITI, as a percentage of gross monthly income. This assessment is particularly important if the institution relies upon reduced documentation or allows other forms of risk layering. Risk layering features in a subprime mortgage loan may significantly increase the risks to both the institution and the borrower. Therefore, an institution should have clear policies governing the use of risk layering features, such as reduced documentation loans or simultaneous second lien mortgages. When risk layering features are combined with the mortgage loan, an institution should demonstrate the existence of effective mitigating factors that support the underwriting decision and the borrower's repayment capacity. Recognizing that loans to subprime borrowers present elevated credit risk, institutions should verify and document the borrower's income, both the source and the amount, as well as their assets and liabilities. Stated income and reduced documentation loans to subprime borrowers should be accepted only if there are mitigating factors that clearly minimize the need for direct verification of repayment capacity. Reliance on such factors also should be documented. Typically, mitigating factors arise when a borrower with favorable payment performance seeks to refinance an existing mortgage with a new loan of a similar size and with similar terms, and the borrower's financial condition has not deteriorated. Fundamental consumer protection principles relevant to the underwriting and marketing of mortgage loans include the following: approving loans based on the borrower's ability to repay the loan according to its terms, and providing information that enables consumers to understand material terms, costs, and risks of loan products at a time that will help the consumer select a product. Communications with consumers, including advertisements, oral statements, and promotional materials, should provide clear and balanced information about the relative benefits and risks of the products. This information should be provided in a timely manner to assist consumers in the product selection process, not just upon submission of an application or at consummation of the loan. Institutions should not use such communications to steer consumers to these products to the exclusion of other products offered by the institution for which the consumer may qualify. Information provided to consumers should clearly explain the risk of payment shock and the ramifications of prepayment penalties, balloon payments, and the lack of escrow for taxes and insurance as necessary. The applicability of prepayment penalties should not exceed the initial reset period. In general, borrowers should be provided a reasonable period of time, typically at least 60 days prior to the reset date, to refinance without penalty. Similarly, if borrowers do not understand that their monthly mortgage payments do not include taxes and insurance, and they have not budgeted for these essential home ownership expenses, they may be faced with the need for significant additional funds on short notice. Therefore, mortgage product descriptions and advertisements should provide clear, detailed information about the cost, terms, features, and risks of the loan to the borrower. Consumers should be informed of payment shock and potential payment increases, including how the new payment will be calculated when introductory fixed rate expires. Let's work through an example. A borrower earning $42,000 per year obtains a $200,000 228 mortgage loan. The loan's two-year introductory fixed interest rate of 7% requires a principal and interest payment of $1,331. Escrowing $200 per month for taxes and insurance results in a total monthly payment of $1,531, which is the $1,331 plus $200, and this represents a 44% debt-to-income ratio. A fully indexed interest rate of 11.5% based on a 6-month SOFR index rate of 5.5% plus a 6% margin would cause the borrower's principal and interest payment to increase to $1,956. The adjusted total monthly payment of $2,156, which is the $1,956 amount plus the $200 for taxes and insurance, represents a 41% increase in the payment amount and results in a 62% debt-to-income ratio.